All right, you all, man, welcome back to the Velocity channel. Listen, I am here with someone you're going to need to listen to, and you're going to want to listen to. This fella has so much experience. Let me tell you, he's currently living South Florida, originally from the Midwest in Michigan. How many of your fans you Michigan fans out there, right? Over 30 years in the financial services industry, has been both a financial advisor and planner, having held as many as 13 licenses in the field. One of the very first adopters of this technology. We're talking about automated velocity banking, right? The system. How many of you know
Mhm.
we need systems out there, right? He's a field partner, certified trainer, and advisory board member of UFF, right? But listen, he's a financial strategist, debt elimination, and equity acceleration specialist. And it is my pleasure. This guy is a leader. And I want you to know that in comparison, right? Me, him, right? There's no comparison. He's the big fish, right? In the pond. You hear me talk up every time, right? About velocity banking, about, debt elimination, about growing your wealth. Well, this is the guy who can tell you even deeper things when it comes to velocity banking. Do you see why you should be listening, right? So gather everyone around. Share this all around the world because this is Richard Schaffer, and he's going to show you what we mean by automated velocity banking. He's going to show you what we mean by he has experience as a financial strategist. Rich, thank you so much, first of all, for coming onto the program and giving to us your expertise so that we can navigate these windy roads that we're on, man. My goodness. Good to have you here.
Really appreciate that. Very, very gracious of you. Uh, it's a lot to live up to, but certainly excited to have the opportunity to speak to you and on behalf of your followers today. It's one of my probably favorite topics, and has been most of my life. So when people tell me I've been in this industry 3 decades, I used to think that was impressive. Now it just makes me feel old. But nonetheless, I started at a very young age, so that probably helps a little bit. But nonetheless, it's when it's pretty much the only career you've been in your entire life. If you don't gain a little bit of knowledge and insight, there's probably something wrong.
Man, that's for real. That's for real. I mean, they were telling me about how, for instance, home equity lines of credit and how some structure of it was actually before the mortgages. I was like, what? Before the
Mhm.
mortgages? I mean, do you know anything about the history of
Sure.
mortgages and like where that even came from? I mean, mortgages. What does mortgage even mean? You know what I mean? Let us know about
Yeah,
that.
let's talk about that a little bit. I think it's a great way to kick it off. I think first and foremost, I, there's a pretty long history to this, but the abridged version is, there was a time when the word homestead was you were given, right, allowed, bequeathed a certain amount of property and you built on it. Right? There was no mortgages, there was no lending opportunities there. You got your own trees, you cut them up, and you built your own home, basically. And that's effectively how it was in our country for quite some time, much longer than most people realize. The early loan instruments, however, when they first started introducing financing, required you had to put 80% down and the bank would finance 20%. And then there was a 5 year balloon. These were very, very short term instruments and they were very heavily equity loaded, if you were, right? Bank didn't have a lot of risk. And it was really for lots of reasons. But as smaller communities were beginning to grow up, they knew that people needed a little bit more, I guess, functionality, you might say, in their homes than they did the basics before. There were new things that were introduced. And so that little extra margin the banks would kind of help you with because they thought it was an investment into the community. And so that made sense for them to participate in it. But when you're looking down the barrel of a 5 year balloon, you better know that you've saved up the money that you can actually pay it off in 5 years. And when they actually started evolving, and this is really honestly at or around post-war era period of time, where they started introducing longer term instruments, 15, 30-year notes, things of that nature. Uh, what a lot of people don't realize is that before they actually fully introduced these longer term loan models, they did a little bit of research and connected with the US Census Bureau. And they realized that the average person at that time lived in their home about 7.2 years. So what they did is that they loaded up as much interest as humanly and mathematically possible during the entire period of time the average person was going to live there. And there's a real psychology behind it, which is called the 7-year itch. And there's a biophysiological aspect to it that says your body completely kind of shifts itself metabolically about every 7 years. You might go from dry skin and oily hair to dry hair and oily skin, right? We change. Our bodies regenerate most of their cells about every 7 years. And none of us think about those things, but it's why, unfortunately, the average person moves in around that time, a little bit less now for various reasons. They get divorced at those time periods, et cetera. It's why it's called the 7-year itch. Marilyn Monroe was in a movie many years ago with that title. But there's a really interesting physical hardwiring. So when you start looking, and this is important to the relative part of our conversation, this is not by gosh or by golly. Almost everything that banks and financial institutions have done have been understanding human behavior and human psychology. And therefore, I hate to say it, we're very easy to manipulate. And as a result, we're very predictable. And banks, and again, I want to say right out of the gate, we're not bashing the financial institutions, but if you go to any city, any state, any country in the world, the biggest buildings you are going to see are going to be banks and financial institutions. And it's for two primary reasons. Number one, it's the golden rule. It's not the one you learned in church. It is he who has the gold makes the rules. So they have the money, possessions 9/10. But the second part of that is that they know what to do with the money. They know fundamentally how to leverage and deploy the use of that money to their advantage. Now, again, we're not bashing the banks, but imitation is the greatest form of flattery. So we want to emulate the proven systems and strategies that banks have deployed for literally decades, but begin to start making those available through technology to the average person in society today.
I mean, and I know a lot of viewers out there are spellbound right now. I mean, when you broke down the biophysiology of it and everything, and how these banks are dead set on making money, it is time. It is time that we gather that system and kind of make it work for us. And I liked how you brought that together. So, speaking of banks, right? Banking systems, their strategies, their ledgers, everything they do, very calculated, right? Because it's not their money, right? It's other people's money that they're
That's right.
making lots and lots of money on, right? So
They
they have
invented
the
OPM, right? They invented OPM.
yeah, they invented OPM, man. Exactly. And so we see the big old skyscrapers, right? But it's coming from people who can barely pay their mortgage, right?
Right.
Isn't that something? So like, how do banks actually make money? Can you like break that down to us? Kind of.
Absolutely. Absolutely. So there's a couple of things to consider here. But let's dispel a couple misnomers. Okay. The average person, and this isn't untrue, it's just only a small portion of the story. It's like reading the outline of a book on the back page. Okay. People think that, okay, well, let's just say interest rates are in the 6% range now for argument's sake. And maybe they're paying you 3% in a savings account. So the average person says, oh, okay, well, that's how they make the money, the spread, right? They're only paying me 3, but they're charging me 6, or they're charging me 8% on a car loan, or whatever the case may be, 18, 20% or so on a credit card. Yes, that's part of it. And yes, they might charge you a monthly fee and they might charge you some overdraft fees, but that's only pittance of how they actually make money. It's about volume and velocity, right? As you allude to with your strategy, but it's how quickly and how many times can you turn and leverage the same dollar over and over again. Banks also take advantage of a very simple concept, very simple concept that says never allow money to remain stagnant. And I'm going to get back to that in a minute. But banks loan money out to other banks in what they call an overnight lending rate, which is about a 0.5 percentage point a day. Now, simple math will tell you that's roughly 180% a year on the average bank deposit ledger, right? So everything else is gravy from there. That 3% spread between savings account and a mortgage, or maybe 5, 6, 7% on a car loan, or 10%, 12%, 15%, on, let's say, a credit card, right? Well, the truth of the matter is that's small fries to compare what they're really making. So that's one aspect of it. The second part of that is that, and I know this sounds like very rudimentary, but let's operate under the premise that I know a lot of stuff's digital now. People deposit their checks digitally, things of that nature. But let's say, as an example, CJ, just for argument's sake, you're in a cash business, right? You do some sort of business that involves a lot of cash. Well, they still have